Hello, everybody. Welcome to today's discussion with Professor Viral Acharya and Dean Raghu Sundaram on Viral's new book, Quest for Restoring Financial Stability in India. As you know, Viral and Raghu are two of the preeminent financial economists of our time. Raghu is now also serving as Dean of the NYU Stern School of Business, where he is expertly steering the school through the unique and unexpected challenges presented by the pandemic. We are grateful to have Raghu lead the school during this turbulent time, and we are sure he will bring us through it with flying colors. Turning now to Viral, he is not only one of the most prolific authors of our generation, he has also made a significant impact on policy during his term as Deputy Governor of the Reserve Bank of India. Viral's wisdom and insights from this experience are now available in his wonderful new book. In addition, reflecting Viral's lifetime commitment to philanthropy, the author's share of the book proceeds will go towards Pratham India, an NGO in India working towards having every child in school and learning well, besides providing skilling for underprivileged youth. It has been my honor and pleasure to know Viral and Raghu for the last 25 years as my colleagues and collaborators. One project in which I've been especially gratified to join Viral and Raghu is the Stern School's India Initiative. Viral launched this initiative in 2012 in partnership with the National Stock Exchange of India. As you may know, despite India's growing importance to the global economy, there is still a dearth of India-focused research in the top journals. Reflecting Viral's deep commitment to scholarship, service, and to India itself, the NSC NYU Stern Initiative on the Study of Indian Capital Markets is an annual grant program and Mumbai conference that identifies, supports, nurtures, and showcases research on India's financial system. Adding to this, in partnership with IIM Calcutta, Viral inaugurated our annual IIM Calcutta NYU Stern India Research Conference at Stern in 2016. When Viral left to join the Reserve Bank of India in 2017, Raghu kindly stepped up and took over as coordinator of the Stern India Initiative. Numerous papers featured in these conferences have already been published in top journals. We look forward to continuing to support and disseminate this important research as all eyes turn to India in the years to come. Now for the format of today's event, Raghu and Viral will be in conversation for 35 to 40 minutes, following which Viral will take a sampling of questions from the audience. Audience participants, you may pose questions to Viral and Raghu at any point during the event in the Q&A box at the bottom of your screen. And now at last, it is my honor to turn the discussion over to Raghu and Viral. Namaste.
Thank you, Jenny. Thank you for that lovely introduction, and thanks to the Salomon Center for hosting this event. It's really a pleasure to be here this morning, although for many of you, I presume it is the afternoon or evening, so welcome to everybody. The main topic of discussion today is on Viral's book, but it's more broadly around the work that he's been engaged in and the analysis he's been engaged in for most of the last 2 decades. As a financial economist, Viral is somewhat unique in his mixture of outstanding theory, empirics, and a very deep interest in policy, which he actually took to beyond theory when he actually served as Deputy Governor of the Reserve Bank of India for 2.5 years. So I'm going to begin with talking about Viral's earlier work and linking it to his more recent work. Shortly after the financial crisis, Viral, along with several other of our colleagues at Stern, authored a book called Restoring Financial Stability. Just 3 words. That book, of course, talked mostly about America and the financial crisis, what had spawned the crisis, and what was needed to restore sanity to the financial system. This book adds a few extra words to the title. It is A Quest for Restoring Financial Stability in India. So let's begin by talking about the difference between the 2 books, what did you have in context when you talked about restoring financial stability in the context of what the challenges we faced in America during that period and the challenges that India faces today? Before I turn it over to Viral, let me again remind you all, at any point you feel like submitting questions on any of the topics, please enter them through the Q&A button, and we'll be happy to take them. I'll be happy to take a selection of them towards the end and post them to Viral.
Thank you, Raghu, and thank you, Jennifer, for the generous introduction. I think in some ways the theme of the two books is the same, which is that we need to secure solid foundations of financial stability in order to deliver on growth in a sustainable manner. Of course, we witnessed this, as a full frontal attack on the financial sector in the developed economies during 2007, 2008. But as you rightly point out, Raghu, the book was just titled Restoring Financial Stability. It was not a quest because I wasn't a policymaker anywhere at that time. And of course, it was meant to be more generic than specific to a country. Nevertheless, I think that I chose the same title for a specific reason, which is that financial stability, in my view, is a prerequisite for much of central bank policy tool-making to work. When we think about traditional models of monetary policy, the fact that the central bank can alter an interest rate, just turn this dial, 12 or 15 wise men and women turning the dial in their office and expecting great things to happen to the economy. This can happen only if the financial sector is actually going to transmit the impulses from the knob over to the real sector of the economy. I think it is an unstated prerequisite. Financial stability is an unstated prerequisite for this transmission of policy to the real sector to work. And I think this is largely ignored in the traditional notion of thinking about central banking. It is no surprise that even today, 12 years after the global financial crisis, there are very few people with banking and financial stability expertise who feature as being significant policymakers inside central banks. Now, I had a rare opportunity in some sense, and I'm very grateful to the government of India and the Reserve Bank of India for giving me that opportunity, because I had the background in banking and finance, and India was at a time when I reached there in 2017 dealing with a very large problem of legacy loans that had gone bad, especially because of the fiscal stimulus during 2009 to 11, 12, I would say. Now, what is the difference between the two books, though? The United States and the European banking sectors, which were the epicenter of the housing boom and bust cycle, I should also say shadow banks, while there is an imprint of the government, notably in the United States in the form of Fannie Mae and Freddie Mac in the housing sector, by and large, these are private sectors. And it was the growing buildup of too big to fail expectations, either explicitly or implicitly, that was the diagnosis in our work after the global financial crisis, that this guarantees being provided by the governments which are causing this Ferrari, which is a financial sector which is terribly efficient. You just deflect its tires a little bit and it's going to run into an accident because it's misdirected. The downside risks are not getting priced. The profits in good times are getting privatized. And this can lead to a massive imbalance. Now, what is different in India, in contrast, is that the government imprint in the financial sector is very large to begin with. More than 50% of deposits and loans are on the balance sheets of public sector banks. These banks used to be private at some point, but were nationalized in two big waves in 60s and 70s. In my assessment, to serve political objectives, the central bank had never supported actually the nationalization of these banks. And like what Larry White always said in the context of Fannie Mae and Freddie Mae that once you create government presence in financial sector, you get mission creep. Every government wants these entities to perform what is the need of the hour, need of the day for that respective government. And so through this imprint of a nationalized presence in the financial sector, you get credit-based stimulus being delivered. You get all kinds of government programs being delivered on the ground. Now, simultaneously in India, especially since global financial crisis, fiscal deficits or government borrowing has been rising very rapidly. Household savings have been declining, much like the savings were declining in the United States before the global financial crisis, because there has been a credit-based push to get consumption to rise in India as well. And growth has not been that easy to deliver, given that the rest of the global economy is not actually powering at full strength. So what has happened gradually over a 10 to 12-year period is that fiscal dominance, where the government starts dominating the policies of the central bank in order to ensure that its borrowing costs are low, in order to ensure that it is not being asked to recapitalize public sector banks, in order to ensure that at the time of short-term electoral or political compulsions, the central bank can be asked to accommodate credit and liquidity stimulus. These sorts of pressures on the central bank have risen dramatically, in spite of India actually having made major strides post-90s to actually move more and more to a market-based system, allowing the regulator to function more at an arm's length. But there is a reversal in these healthy trends. And my diagnosis in the book, which is a bit different than the first book we wrote on the crisis, is that in India, increasingly the problem of financial stability or lack of it is one of fiscal dominance of an all-purpose central bank's policies being under pervasive, comprehensive, and persistent pressures to give in interest of short-term growth. And I think I would say that initial starting point of public sector presence and the not so benign government borrowing conditions are right now the two central issues in India's financial sector stability. We made a quest. I think we put up a good fight to arrest these issues. I think it was still worthwhile in the sense of moving the discussion and the direction forward. But more needs to be done, and I'm happy to talk about what it will take to fix the problem head on.
So we'll get to that in a few minutes, but I wanted to develop on this theme just a little bit more. It was not only, of course, banks, insurance companies also got nationalized in India in waves. And so most large financial institutions came under government control one way or the other. You spent a lot of your first chapter of your book talking about this problem of fiscal dominance. But let's put that in context, in a broader context. So in an international context, how unique is the problem that India is facing today? Because there are occasional points where you discuss, for example, the reserve policy in China and its use in doing sectoral allocation. Now, China's economy is being far more successful than India's, with a much greater central control. But there are other countries where fiscal dominance has proved a very serious problem. So can you put this into a larger context for us in terms of what India resembles and what it does not in terms of the problems it faces?
Absolutely. That's a great question, Raghu. Of course, in many ways, fiscal dominance of central banks is rising throughout the world, as we have observed, especially in the COVID phase, where central banks and governments are delivering a large number of solutions to aid the financial sector, transmission of monetary policy, direct support of markets and borrowers joining hands willingly or unwillingly. What is different in the context of India is that there was a time when this was not a problem for India. And I think China is a great example as well. In case of India, Dr. Y.V. Reddy, former governor of the Reserve Bank of India, he writes in a masterful foreword to my book that the government, the central bank, and the public sector banks were what is in India called as a Hindu undivided family, where no one kept anyone's accounts properly, because the whole idea in the nationalized era was to repress the private sector and the rest of the financial system so that everyone's deposits were essentially being directed to fund the fiscal deficit programs. Now, this means two things: that it was not possible for anyone else to grow because of the nationalized control. And second, it was also the case that there was no discipline on the government on its borrowing programs, because either the public sector banks or the central bank, through direct monetization, would always be out there to fund the government's fiscal deficits. The result of that was decades of macroeconomic mismanagement that ultimately led to the balance of payments crisis in 1991. And of course, I see that crisis and the reforms that have happened since as an acknowledgement that the country, given its demographics, given its aspirations, given its poverty, can no longer continue to grow at the Hindu growth rate of 3%, which the nationalized era was delivering. There was no financial instability during the nationalized era. That's the beauty of public sector banking. It doesn't lead to fragility, which can send signals that the system has imbalances. Everything was a beautiful, cozy arrangement. Now, the private sector is large, it is thriving. There is a private sector also in the financial sector. And the government, through government's own choices in the past, is now required to go and borrow in the market rather than being automatically financed by the central bank as and when its short-term expenditures expand. So what is happening in case of India, and I think this is a bit similar to the rest of the world, that unfortunately, I think we have lost respect for the markets. The interventions in prices and quantities in markets from central banks and other regulators have become now on such a massive scale that effectively it starts looking in sort of net terms as though the central banks are doing massive automatic monetization of government deficits. Yes, they may call it quantitative easing, they may call it QE1, QE2, or large-scale asset purchases, whatever name you want to call it. But the truth is that this is in one way or the other monetization of government deficits. And it's no coincidence that developed country balance sheets have grown very large in deficits over the last 10 years. The borrowing costs remain relatively low. I understand these are safe haven currencies. Nevertheless, the borrowing costs have remained lower than what they would be had the central banks not stepped in as massively. And in fact, if you look at European Central Bank, I would argue that much of its actions over the last 7-8 years have been precisely to ensure the euro doesn't break up, which is that the periphery countries can continue to maintain their large fiscal deficits at low cost. Now, I am in principle okay with these as stopgap arrangements after a crisis such as a global financial crisis. But once this becomes a policy for 10 years, I think you have to ask the question, did underlying structural reforms take place in these economies? And coming back to India, that is the real question again, which is that an economy which was moving towards a market-based economy is now showing signs of regressing back to more of a nationalized era style financial arrangements where the decks are always being arranged in such a way that the government can roll over its borrowing programs at a cheap cost. This has massive costs to financial stability, as I explain in the book, because it compromises bank regulation. It has massive crowding out costs because the private sector is not going to be able to invest because its borrowing costs are not reasonable. And in fact, because the government quantity of borrowing is so large, there is no pass-through of monetary policy other than to push it on a string and inject such massive quantities of liquidity in order to derive like small transmissions in the end. So I think the question is global, but I think India's problem is more severe because it is not a safe haven currency. It has a relatively low per capita GDP. and its demographics are such that a huge number of jobs have to be created every month. And so if growth goes back towards the Hindu growth rate of the nationalized banking and the centralized economic arrangement era, I think it has huge consequences for welfare of the citizenry. Just last point, Raghu, on China, which is that I think China is an interesting model because clearly it is centralized. Its bureaucracy has been well functioning in many ways, even with all the normal problems of a thriving bureaucracy. And yet it seems to have embraced a certain level of market reforms and privatization of the economy half-heartedly, with clearly big presence of the government, including in IPOs and various bond markets. But I would say we should watch out for another 10, 20 years before we form firm conclusions on whether the Chinese model of growth is likely to be easily emulated by other countries, given democratic compulsions that they might face in decision making.
So let me get back to possible solutions in a second, but I'm going to bring in another topic. This is an issue that has received enormous attention worldwide, but especially in India, where the government financial inclusion, where the government launched the banking the unbanked, open 350 million bank accounts, so on. So, how much is a significant part of India's population continues to be outside the formal financial sector, and we saw the impact of that during the demonetization drama a few years ago. And we saw it again this year during the lockdowns when the impact on the poor was disproportionately large. How much of this fiscal dominance, this is not an issue you pay attention to, you focus more on the macro stability issue. But so there are two questions I'm going to ask you, and they are separate but related questions. How much is fiscal dominance hampering the growth of financial inclusion in India? And secondly, this is actually a question somebody has already posted on the chat side, but I was going to ask you that anyway. One of the things you talk about is the likelihood that this is hampering growth, that this is creating misallocation. Have there been attempts to quantify the impact, the what-if impact of fiscal dominance?
Yes.
They're separate but related questions on inclusion and quantification.
Yes. So I think I go back to Larry White's comment again, that what I have observed with nationalized institutions in the financial sector, that they basically, their only purpose is to have a mission creep so that each successive government can keep asking them to do what it wants for its relevant vote bank. Let's put it that way in sort of plain, simple English. Ultimately, these are populist measures designed to reach your respective constituencies. If the purpose of public sector bank nationalization in 60s and 70s, so of course private sector banks that got nationalized, if the purpose of nationalization was to produce development and financial inclusion at the last mile, after 50 years of their existence, India should not be at a 55% debt to GDP ratio at the household level. There are parts of India in Northeast India where credit to GDP ratio is less than 5%. These banks have, so the irony of their rise and fall is that they rose because they were the only game in town. Once they have competitions from private banks since 90s, they have now fallen in their market share. And how have they fallen? They have fallen by poor underwriting of large loans to some of the largest industrial houses in the country. So the idea that these entities needed to be nationalized for serving government's development objectives in the end, I think needs to be seriously questioned, because what they have failed is as universal banks that are trying to provide the largest loans to the largest defaulted borrower of the country, so to speak. Now, but there have been successes. I wouldn't say that there has been no financial inclusion, because that's a big part of the mandate of the central bank in India. And of course, there is what is called as priority sector lending, where certain proportion of loans has to be earmarked for pre-designated areas, similar to, if you want the Communities Reinvestment Act lending in the United States, or Fannie Freddie's requirements for mission goals, so to speak. So financial inclusion has been achieved, but actually India's largest success stories of financial inclusion in the last 10 years have actually been small finance banks and microcredit institutions. These are entities that are borrowing and raising funds. They are doing last mile delivery of loans. And yet they are able to simultaneously generate profits along the way. The only significant financial inclusion that has happened in a big way through public sector banks is the one you mentioned, where demonetization produced an effective formalization of or laundering of informal money that came back into the formal system through a variety of slippages. And of course, that time a massive amount of Jan Dhan Yojana accounts got created, as you said. The question is, suppose you had private sector banks only in the country at that point of time, wouldn't the money have got formalized? I think the money would have gotten formalized that time anyways because of slippages in the system. I think the last point you mentioned, is it possible to quantify the costs? So I have done a simple calculation. Of course, it's hard to know the returns on financial inclusion, so I've only assessed the costs of public sector banking. So we took all the capitalization that the government has put into public sector banks over the last 12 years. And we asked the question, instead, suppose this had been invested in the stock market in India, because these are equity investments in the end, or if this had been invested in the private sector banks in India, the Indian government would have saved between 2.5 to 3.5 trillion rupees, which is basically the equivalent of 40 to 50 billion dollars. Now, if that kind of saving was available right now in the midst of the pandemic to provide direct benefit transfers to a large number of Indians who now have the bank accounts, thanks to the financial inclusion that has been put in place, it would have been a massive relief, counter-cyclical relief. But unfortunately, the public sector banking has become a guzzler of taxpayer money. It is primarily right now serving the labor that is employed there, and one has to ask if this is the best way to create jobs in India. Second, it is primarily serving the large industrial houses who have been evergreen repeatedly on their bad loans, as I just described. And third, it is serving the short-term political objectives of getting some stimuli being pushed into specific parts of the country or the favored constituencies, which keep changing from government to government. So in my view, the question is spot on. What is the quantitative cost of this? I have one estimate, perhaps better estimates can be provided. But worse is, I think, a point I make in the book, which is that because this creates pressure on the central bank to relax its rules all the time, it is also forced to adopt weaker capital norms, weaker asset quality recognition norms, weaker standards of various types, even on the rest of the banks, because the central bank doesn't regulate the two entities with, it does them in an ownership neutral fashion to the extent the law allows. But therefore, there's a race to the bottom because the regulations can't be raised, because public sector banks won't be able to meet them. The entire system actually functions at fairly weak levels of prudential regulations in India. Now, it's hard to quantify the cost of that because you're always running essentially, in the book, I call the Indian financial sector is like a rubber band that is always stretched. You put a little bit of pressure on it and it snaps.
So let's get to what can we do about it? What do we do about it?
So in the book, I give a two-pronged proposal. Because my diagnosis is that one of the key deeper interference in financial stability is coming through fiscal dominance. The first prong is on improving the country's fiscal institutional reforms. And there's a 5-point agenda there. Let me quickly focus on that. First point, India has a Fiscal Responsibility and Budget Management Act passed in 2003, which subjects the government to meeting certain deficit and borrowing targets. Now, these have always been slipped upon, even in normal times, even in non-COVID years. Nevertheless, given the COVID shock and the need to maintain medium-term debt sustainability perceptions with the markets, investors, rating agencies, these norms need to be re-adhered to. I think a statement needs to be made that we mean business as far as debt consolidation is concerned, because otherwise the analyst projections are that debt to GDP ratios could start slipping to 85 to 90% range over a 3 to 5 year period. And these would be very large numbers to deal with. Second, why has the slippage happened? The slippage has happened because there is no independent bipartisan fiscal council, such as, say, a congressional budget office, for example, which monitors the usage of funds and ensures adherence to these targets. So we need such a council to hold a mirror to the governments, each successive government, on its progress. Every year, the government announces its budgeting plans, and all that it primarily engages in two fiscal tricks. One is that growth is always going to be fabulous next year, so the tax collections will be very high. And the second is that if in spite of fabulous tax collection assumptions, you still have a hole in meeting the targets set by the FRBM Act, then that residual gets put into what is called as a disinvestment target. So disinvestments in India is basically a residual item on the government budget where they announce what every year looks an even more fantastic target than the previous year. And how are the disinvestments done in the end? They are done through what I call as musical chairs between public sector enterprises. So one public sector enterprise goes and borrows in the markets. It acquires equity stake in another public sector enterprise. That results in a dividend for the government for accounting purposes. And the debt of the first public sector enterprise that made the acquisition remains off balance sheet. So the debt is never explicitly recognized, even though this is really seen as a sovereign guaranteed debt. So this independent fiscal council needs to vet the budgets. It needs to hold a mirror to the government as to whether the progress is official or whether the progress is real in an economic sense. Third, more than 90% of the central government's expenditures in India are populist revenue expenditures. These are not expenditures in health, education, and infrastructure, which together constitute less than 5% of the government budgets in India. States in India do slightly more capital expenditures, but even that is on the order of 20 to 25%. So we need a massive rationalization of these populist expenditures. I think a good approach would be to rationalize and roll them out all into a single universal basic income. Perhaps, set at a reasonable level that provides some compression of the expenditures. It would be more efficient to let households decide where they want to spend the money. The rest can be freed up to generate long-term fiscal multipliers through health, education, and infrastructure investment. So rationalization of expenditures is point 3. Fourth, transparency of the government finance. Right now, it's not possible to calculate a single number, which is an official number of the total public sector borrowing requirement in India. If I want to spend 1 year and figure out how much total borrowing is undertaken by the central government, state governments, central-owned public sector enterprises, and state-owned public sector enterprises, it's not possible to do this calculation because many of these entities don't even produce annual accounts. So we clearly need a transparency of where we stand on the actual total government borrowing that is taking place in an effective sense, because otherwise you don't know where you need to be in 3 or 5 years' time and how much of a course correction is required. And fifth, related to the point on disinvestments, I think India has no choice right now but to disinvest heavily. We had a backdoor disinvestment done through liberalizations of the post-1991 reforms, where we didn't divest stakes, but we just allowed a lot of private sector operators in airlines and in many other sectors, in telecom, etc. Then during 1998 to 2003, a very significant wave of actual disinvestments were undertaken, where government actually sold stakes, majority stakes in many cases. It got rid of majority stakes in several public sector enterprises. I think India has no choice but to reduce the burden of borrowing and actually to raise equity finance on several of these enterprises. And I think the best place to start would be the financial sector, bring down stakes in public sector banks to maybe 25% to 30%, including in insurance firms, and perhaps reprivatize some of them, which are already large universal banks, not necessarily performing development and financial inclusion functions, and refocus some of the smaller public sector banks to perform the financial inclusion goals. So that's the first prong on the fiscal. On financial stability, I'll keep it brief in interest of time, Raghu. I'll just make 3 points, which I think are crucial. First and foremost, ownership, regulation of banks should be allowed to be ownership neutral. Right now, the Banking Nationalization Act in India overrides the Reserve Bank of India's powers in regulating the public sector banks. As a result, public sector, the RBI doesn't have powers to subject a meaningful prompt corrective action on public sector banks, because you can't fire management, you can't actually replace equity with new equity, because these powers reside with the finance ministry and not with the regulator. So either you make them private so that then RBI is regulating private banks, or you basically give RBI the legal powers which are equivalent to those over the private sector banks. Second, India needs to adopt a lot more rule-based decision making. Right now, that's part of the Inflation Targeting Framework and Monetary Policy Committee that was set up in 2016. But regulation is the weakest area which comes under constant government pressure. And I think if rule-based decision making could be put in place here, in terms of firm capital requirements, maybe stress test based capital requirements, I think that would be a big help. And the last point that I would add here is that in India, defaults on bank loans are pretty much not disclosed transparently to rating agencies, to markets at large. This is extraordinary. It's an extraordinary form of fiscal dominance where a company that my dad owns as a minority investor, he doesn't have the right to know whether this company has defaulted on a bank loan. And it's a very convoluted logic, because if the loan defaults, then it will be downgraded by rating. The borrower will be downgraded by rating agencies. This will result in greater provisioning and capital to be put up at public sector banks. This will increase the exchequer's bill for recapitalizing the banks at the end of each year. And this would eat into their otherwise fiscal expenditures. They don't want to do this, so my dad doesn't have a right to know as a minority investor whether a company he's investing in has defaulted on a bank loan or not. Now, of course, you may say, maybe the cost of capital must be high. I think it is high in India. Maybe ratings are not perfect. They are not perfect. There's a huge inflation of ratings, because rating agencies can always just throw up their hands and say, oh, we don't get the information that we want, so we couldn't really figure out whether this firm deserved to be high rated or not. So I would say improvement in default disclosures, stress test based capital requirement rules, and ownership neutral regulation of banks are the 3 most critical pillars of financial stability from my viewpoint.
So I agree with almost every bit of your analysis, but this, I don't want to sound cynical about this, but where are these reforms going to come from? I mean, when you talk about creating independent organizations like the CBO, or even your A.D. Shroff Memorial Lecture on the importance of central bank independence and other issues. In India, ultimately, these have to be, as you said, 2003, it was actually led by the then government to bring in these reforms. Since then, no government has shown an interest in sustaining them. So when you talk about independence, when you talk about privatization, when you talk about governments taking a longer term view when they face elections every 2 or 3 years at the state level or central level in India, it's hard not to be cynical about the prospects of these kinds of changes coming through, except in a crisis. India seems to change only when there is a crisis.
I tend to agree at one level, Raghu, but I have to say I've not yet given up hope. I think my sense is we need a lot more public debate and discourse. There is a tendency in India not to question any official statistics, not to question whatever is the lay of the land at the present point of time. There's a tendency to simply accept things as they are and optimize within that, rather than actually identifying solutions that can just push the envelope to a better place. So I think the spirit of the book is to present my diagnosis, assessment, and a set of reforms. I'm fully aware that these may not always be the right solutions. Perhaps there are better ideas. Maybe the timing may not be right for some of the reforms. Nevertheless, I'm hoping that the book stirs at least public debate. Now, what would be problematic in my view is that we wait for a crisis to undertake the reforms, because as I mentioned, in 70s and 80s, we weren't a market economy. There wasn't a private sector. There weren't markets. I think a crisis that comes next for India is not going to be as benign as the previous ones were. They will be more violent because the markets will be whiplashing you for not having maintained macroeconomic and financial stability. Also, in times of when you undertake decisions such as large divestments, in the midst of a crisis, governments end up selling these stakes at basically fire sale prices. And in a taxpayer sense, those may also not be the best times actually to get rid of these stakes. And the third point I would say is that even though it was a quest, and I fully acknowledge that restoring financial stability for the long run in India remains an unfinished agenda, at least certainly from the standpoint of my term at the central bank. I do think that progress was made, and let me explain. I think every single speech that I wrote, which are all contained in the book, they had a very clear structure. I first presented a body of international facts and evidence as to similar problems existing elsewhere. Then I explained what worked and what didn't work. Then I presented the Indian context, and then I drew lessons on what India could do. And I found that actually this was a very powerful tool for advocacy for change. And actually we were in the direction of the right path until certain short-term compulsions arose. And then, we sort of started regressing back. Maybe with slightly greater distance to short-term compulsions arising again. Maybe if the right public debates happen, some consensus is found on requiring necessary fiscal reforms and financial stability reforms, progress could be made. Last point, I think COVID on this front gives me hope, because government needs to undertake necessary expenditures, both on health front, improving health infra going forward, as well as to make certain direct benefit transfers to the most affected individuals and businesses. It needs to create space, and right now it's hard to find in its fiscal arrangements. The only way out is to undertake the necessary expenditures, but build medium-term commitment through fiscal institutional reforms to tell rating agencies, investors, and markets that, listen, don't whiplash me for my expenditures. I mean business as far as coming back to a decent fiscal trajectory is concerned. So I'm maybe it's just a little bird that's fluttering inside me and keep singing every day morning, but I remain hopeful that we can still move on.
I agree. I think if one loses one's optimism, life becomes impossible. I'm going to switch to questions in the interest of time. There are a few questions that have come in. I did also want to ask you about your general view on central bank independence and the prospects of preserving it in the world we are in. There was a period in the world in between the 1970s and 1990s when most countries bought into some notion of central bank independence. And crisis after crisis, that independence seems to be getting eroded in many ways. And it's not just in the Indian context, but we can get to that in later if we have time. Let me go to some questions. There's one question about a more global context that one of our audience members has posed, which is, when you talk about lower global interest rates, how much of them are due to the asset purchases by central banks, and how much of them are just due to the fact that private assets have grown enormously over time, over the last several decades, and have become global in nature. The explicit question that he asks is, are bond markets reacting more to the asset purchases because they're more visible in the daily news?
Yeah, it's a tough question. I don't have a very well-researched answer to provide, but I do draw some inference from cross-country studies subject to all their usual concerns, which is that one view of the low rates is that inflation is low to start with, and therefore, the rates are warranted to be low in the first place. And that, simultaneously, perhaps potential output growth has declined, and so monetary policy maybe has to factor that in as well. But what you see when you compare notably countries in Europe with, say, countries such as United States, what has been a big departure between them in the last 12 years? They both had spectacular crises in 07, 08, maybe by some measures even more spectacularly so in United States than in other parts of the world. But United States had a central bank that in some sense suffered significant retribution, if I could use that word, as a result of this, and went on a war footing to use stress tests and recapitalize its banks. A public consensus in the United States moved in the direction of at least getting something like a Dodd-Frank Act being put in place, regardless of what its imperfections might be. Indeed, on some cases, people thought it was an overreach in some dimensions on restricting the financial sector. Europe simply kicked the can down the road as far as recapitalizing banks, etc., was concerned. And my sense is the inflation and growth outcomes in these two important parts of the global economy have differed primarily because of financial sector responses. Europe has taken a path of not recapitalizing banks, allowed zombie lending to fester. It has killed the productivity of several indebted parts of its economies, especially in the periphery. And the central bank has gone on a limb supporting the fiscal overstretch of several periphery countries rather than getting structural reforms as a quid pro quo in return. United States, in contrast, didn't do that. And so inflation and growth have recovered far better in United States, in my view, than in Europe. I think Europe looks like the Japan of the 90s, in my view, as far as the financial sector was concerned. So I don't know all the other factors that are causing inflation, growth, and private sector assets to grow. But my assessment is that financial stability and capitalization of banks, the quality of their loans, resolution of indebted sectors, and their impact on productivity of healthy firms should not be ignored when we assess inflation and growth outcomes in different parts of the world.
So let me, you mentioned that COVID actually gives you some optimism that pressures on the government to reform are going to come down. But it is during COVID, this is one of the questions that one of our audience members has posed. The moratorium on payments that has been imposed by the government has worsened the situation for banks very significantly. So in the short term, things seem to be getting worse, not better, because of the fiscal dominance issues. How do you see this playing out?
Yeah, it's a good question.
In some sense, will COVID lead to increased fiscal dominance and a worsening of the situation?
Yeah, it really depends on how the packages are structured. See, some countries entered COVID with relatively stronger financial systems. Some countries, such as India, were already doing the cleanup of the past decade of leverage boom and bust when COVID hit. In Europe, you see a great divergence between the core and the periphery as to the health of the banking sector still. And, it gets reflected even in observable metrics such as the market to book ratios of these banks, their profitability, and so on. So clearly, countries which have not prepared their financial systems to be in decent shape will have a harder problem dealing with the losses. What needs to be done, in my opinion, is that while accommodation is made for individuals and corporates with debt moratoria I think they should be temporary at best for 3 to 6 months max. On a war footing, I think capitalization of the banking and the non-banking financial system needs to be raised to withstand the likely losses which are going to manifest. I think this idea that somehow the growth recovery will be extremely rapid and sharp V-shaped, I think that's one possible trajectory. A possible trajectory is that the global growth was declining even coming into COVID because of some of the other tensions. Maybe those tensions could get worse in the years to come. Maybe a Cold War with China could actually mean a very significant and painful adjustment of global growth for a period of time. And of course, there is growing protectionism that one has to factor in while thinking about inflation and perhaps growth in various economies. So I think there is a huge band of uncertainty around a likely path of recovery. It's still unclear when the path of recovery gets onto a firmer footing in the first place, given infection curves are rising, vaccines are at least 6 to 9 months away, if not longer. So there will be losses. Some restructuring has to take place. We can't bail out every single individual and entity that is out there. So banks will have to take losses. The shadow banks will also have to take pain. Are they prepared for it? I think I would do stress tests on a war footing in every single financial sector of the world. Equity markets are benign thanks to the fiscal and monetary interventions. Why waste time? Use it to actually shore up the capital into these entities so that as and when the recovery take place, they are positioned to lend well to the economy. I think what would be terrible is if we fix the health curve, we get vaccines, the private sector is willing to grow, individuals are willing to get back to jobs and start their businesses as usual. And the financial sector is now cleaning up the mess left after the COVID because it didn't have the right buffers. I think that would be exactly the wrong kind of growth stimulus that the financial sector could provide at that point of time.
Okay, so we'll take 2 more questions, I think, in the interest of time. There's one interesting question that one of our viewers has posed, which is a hypothetical question. If you could have any data that you needed, what's the most interesting analysis you would have performed on to assess the health of the financial sector in India, other than things like stress tests and capital adequacy tests?
I think right now it is what I said earlier, which is that I think the big elephant in the room in India is actually the fiscal deficit. It's the government debt sustainability. What I would really like to know is what is the true public sector borrowing requirement, which includes on-balance sheet and off-balance sheet expenditures of the government of India. Because I think this is going to be the single most important fiscal dominance force on the all-purpose central bank that India has. It's going to be the biggest compromise that could arise. The central bank could come under pressure to accommodate the borrowing programs. The question is whether, in spite of its inflation targeting mandate, will it be allowed to stray and focus on the debt rollovers instead of maintaining long-run price stability. In fact, the framework is up for review in the next year, and I think what happens to that review will be a very powerful revelation of whether the process itself is going to get fiscally dominated by changing the rules of the game within 5 years of having put in place an inflation targeting mandate for the central bank.
Okay, now let me, final question. I'm going to get to the thesis in your Shroff Memorial Lecture, Central Bank Independence. I said I wanted to talk about this because we saw your predecessor at the Reserve Bank, not your predecessor, but the governor of the Reserve Bank, Raghu, getting savagely attacked in the media sometimes by trolls, but mostly by political partisans. They were ad hominem attacks. You encountered many of those ad hominem attacks yourself, where we are in a world today what's happening in India was also a microcosm of what's happening in the world, where attacks are running public institutions, but being a public figure is getting increasingly more difficult because of the nature of attacks that keep coming and the incredible partisanship of the press. The media has long since ceased to be a neutral observer in anything that is going on. Most of the media disgraces itself with its positions very often. In that kind of a situation, how do you see central bank independence globally, also with reference to India, actually playing out? As you know, I'm going to, for some of our viewers, have to put this in context. Both Viral and Raghu were attacked for being American academics. They said, what do they know about India? So you get ridiculous accusations that have nothing to do with the policies. In that context, how do you see central bank independence globally playing out? You've seen our president attack the Federal Reserve Board at will in public.
Yeah, I think in a way it's a very interesting and perhaps a crucial time for the global economy, in my view. At a low frequency cycle, I think the impact of the global financial crisis on what is happening and will happen can't be understated. I think the lack of being able to deliver growth in large developed economies has created a massive resentment in the population against the income inequality and other sort of observable statistics. Lack of adequate redistribution policies is emerging as a failure of what is otherwise, considered to be like a good model for governance, the sort of the electoral democracy and so on. I think I'm a bit concerned, more than a bit concerned, that we are moving in a direction that we had seen in the last century around this time. We are moving towards centralization. We are moving towards greater and greater role of the government. It's almost natural when a government balance sheet is so large, it can only happen if it is playing a large role in the economy. And will it lead to similar sinister outcomes? I don't know. I think, therefore, in my narrow view of central banking, what the point I was trying to make in Eddie Schroff Memorial Lecture was that we should view the central bank as an important institution, as an important long-term institution, just the way we think about rule of law, we think about enforcement of contracts in a bankruptcy court. We should think of central bank as an important checks and balances performing institution for the economy. You give it a long-term mandate. And I almost think about it as, to use the analogy from Homer's writings, it's like the Odysseus being tied to the mast so that he doesn't have to give in to the call of the sirens. And I think of these long-term mandates and rule-based decision-making as essentially the economy's commitment that checks and balances will be in place in a democratic system to ensure that the short-term electoral pressures don't take this Ferrari of the financial system helter-skelter in colliding on the sides. So I think the central banks, I hope, will stand up like Paul Walker did during the Reagan administration, as I mentioned in the introductory chapter. I think there are other examples. Of course, a part of it becomes difficult because the appointments will begin to get compromised. That's also a way that the fiscal dominance gets engineered into the central banking in the first place. But therefore, we need more voices. I think we need more reason. And I think we need an explicit recognition that the central bank's role at the present point in safeguarding these long-run objectives is likely to have outcomes that go beyond actually just the financial sector implications, in my view. If I could just end with the following analogy, Raghu, which is a bit thought-provoking. It sounds a bit pessimistic, but I mean to raise it only as a way of whether we can prepare better in this century. 1907, big banking panic in the United States, 2007-08 global financial crisis, 1918 to 1920, the Spanish influenza, and now we have the coronavirus in 2020. Big movement towards, centralization, authoritarian populist leaders at that time. we are seeing the same trends right now at the beginning of the century. I think the key question that most of us should think about and be concerned about is, will this century turn out to be different, and what role, from my narrow point, can central banks and financial stability play in this context?
Thank you, Viral. That was terrific ending, although it sounds like the beginning of a second conversation.
So thank you, Raghu, and thank you to all the participants for your questions. I hope you enjoy reading the book, and even though it's written for India, I think the issue of fiscal dominance, as Raghu has been repeatedly asking, is I think going to be relevant in developed economies as well.
Absolutely. So thank you to the Salomon Center too, and to Jenny. To those of the participants whose questions I didn't manage to get to, I'm sure Viral will be happy to answer them if you send him an email. You can find his email on the Stern website. And so please don't hesitate to reach out, and thanks everyone.